Welcome everybody to Richey May's webinar today on Home Mortgage Disclosures Act. We're going to wait just a couple more, maybe 30 seconds or so, see if anybody else joins on. Hang tight with us. We'll be back momentarily to kick things off. All right, I think we're going to kick things off now. Once again, thank you everyone who's logged into the webinar today. The topic choice today is evidenced as very important by the sheer number of attendees we have. Definitely our most popular webinar to date. I attribute most of that to the great panelists we put together and the timely topic. So thank you again. To start off here, need to cover some housekeeping issues. A lot of you have indicated that CPE is desired out of this session today. So just as a reminder, please answer all 4 poll questions to receive credit. They're scattered throughout the presentation. During the presentation, everyone will be on mute except for the panelists. We'll reserve time at the end. We'll do our best to wrap things up so that we allow for some questions that can either be sent to the contacts or using your dashboard within GoToWebinar. There's a feature to submit questions. Should we not have the time to get to all of those, we'll definitely follow up with you directly to get your question answered. And James, who is on the call with us today, has graciously offered to put together a list of all the questions so that everyone can benefit from what's on single people's minds. A recording of the webinar will also become available, as well as the slide deck. We'll email a link to those publications after the webinar, sometime probable tomorrow. Last thing, I guess, is that a survey will appear on your screen following the close of the webinar. Please fill that out to the best of your ability. It helps us. It helps us in the future with, making our presentations timely, topical, and follow, what's on our clients' minds. Last thing, I guess, is the CPE certificates. I'm sorry. They'll be emailed to you as well following the webinar. It's my pleasure to introduce to you the panelists today. First off, my name is Richey. I'm the mortgage banking practice leader here at Richey May. I've had the pleasure of meeting many of the attendees on the webinar today, but if I haven't, my contact information will be placed at the end of the slide deck. Please feel free to reach out to me anytime. Happy to schedule a meeting at any of the various conferences around the country or facilitate any questions or connections that you're interested in. We also have on the line James Brody, the Senior Managing Member at the American Mortgage Law Group. We have a team of specialists from Alvarez and Marsal from the financial industry division. Brian Driscoll, Senior Director, Richard Hendrick, Senior Director, Matt Frank, Director, and Zhao Yao, Manager. From Richey May, we'll have Tyler House, come on the line towards the end of the presentation. Tyler's a manager in the Business Advisory Services group here. To kick things off, we have our CPA CPE poll question number 1. That'll be launched now on your screen. Give us just a minute to collect data and results, and then we'll get going. All right, thank you. As you saw, the question that was asked kind of related to why we're all here today. A topic that's on many people in the industry's mind is HMDA, the Home Mortgage Disclosures Act. It's very timely now because it's a year in which changes are scheduled to take place starting January 1 of 18, just 2 months away from now. And within the last month, the public data was also released for all data accumulated for the 2016 calendar year. So with all that going on, we felt it appropriate to get a panel of experts on the topic together, hopefully offer some useful education to the group. To kick things off, it's my pleasure to introduce James Brody to you all. James is, as I mentioned, the managing member, and he's actually one of the founding members of the American Mortgage Law Group. For those of you not familiar, AMLG is a firm dedicated to serving the legal needs of arguably one of the most regulated industries in the country. James has resolved hundreds of cases around the country involving complex mortgage fraud schemes, large-scale repurchase or make-whole disputes. His focus is also is on legal issues that arise during the loan origination, loan purchase and sale transaction, loan securitizations, foreclosure, bankruptcy actions, and repurchasing stages of the life of a loan. These credentials definitely make James uniquely qualified to educate the group today on the HMDA rule changes scheduled to take effect starting in 2018 and continuing thereafter. James, I'm going to turn the floor over to you. Feel free to give us some more insight on AMLG, and then we'll get right into it.
All right. Well, listen, I appreciate that. Thank you very much for having me. And I'll go ahead and just give a little bit more information on the American Mortgage Law Group. And again, thank the audience. It looks like we've got a great turnout here. You know, the AMLG, you know, we're known widely in both the legal and mortgage banking industries as being experienced in representing the financial institutions with regards to mortgage-related services. Now, while we are a California-based practice, we do have attorneys who are licensed in a number of different jurisdictions, and we continue to serve our many mortgage banking clients throughout the country. We're dedicated to providing all our clients with the best representation possible and creating a value add for our clients. In addition to the mortgage fraud and the repurchase disputes, as you had nicely mentioned, you know, we are also very heavily involved in the regulatory compliance practice as well, and have several attorneys on our staff who come from a variety of different compliance-related backgrounds, as well as having dealt with and worked for and with the regulatory agencies. That being said, I'll go ahead and just give you a very quick notice here as we proceed, and I'd just like to make that quick disclaimer that nothing in today's presentation that I provide will constitute legal advice or will create any sort of attorney-client relationship between the parties to today's webinar. Now, getting right to it here, there we are on slide 8. HMDA was originally enacted in 1975 and requires lenders to collect, report, and disclose data about originations, purchase loans, and applications. There are 3 main purposes for HMDA, and that is providing information to the public and communities on whether lenders are serving housing needs, to help public officials determine whether to put public sector investments to attract private investment, and really to identify possible discriminatory lending patterns and enforce anti-discrimination statutes. Now, Dodd-Frank transferred regulatory authority and other functions of HMDA from the Federal Reserve to the CFPB and significantly expanded the required information and authorized the CFPB to require additional information. Now, the CFPB had issued a new HMDA rule in 2015, which expands reporting coverage for non-depositories and reduces coverage for depositories. It greatly increases the data elements to report and increases and redefines transactions that are covered. It also requires a new reporting format and potentially increases your exposure to fair lending claims, and then also finally makes data more publicly accessible. So let's get right to the rule itself. Now, CFPB phrased in parts of the rule, but nearly all aspects will be effective beginning January 1, 2018. We're going to look at the rule as it will be effective January 1 in 2018. And as I said, we'll try to point out how things changed from 2017 to 2018, as that is, of course, coming up here. Now, let's start with who's covered by HMDA, and there are threshold tests for both depository and non-depository institutions. We'll look first at the questions for depository institutions. Did you have assets greater than $44 million on the preceding December 31st? This threshold is subject to change, but right now it is $44 million. And if the answer is yes, then you keep going. On the preceding calendar year, did you originate at least one home purchase loan or refinancing of a home purchase loan secured by a first lien on a family dwelling of 1 to 4? If yes, then again you move on to the next question. Are you federally insured or regulated, or was the above loan insured, guaranteed, or supplemented by a federal agency, or was the above loan intended for sale to one of the agencies, those being Fannie Mae and Freddie Mac? This next question changed from 2017 to 2018 because previously the test was whether you originated at least 25 home purchase loans, and this was including refinances of home purchase loans, and this was in each of the 2 preceding calendar years. Because they've changed the rules for how to determine if a loan's covered, this question has changed. Beginning in 2018, the question to be asked is either or, did you originate at least 25 non-excluded closed-end mortgage loans in each of the 2 preceding calendar years, or did you originate at least 100 non-excluded open-end lines of credit in each of the 2 preceding calendar years? Now, this threshold issue of 100 for open-end loans has been increased temporarily to 500 for the years 2018 to 2019. If your answer to all of the questions is yes, then you are a covered financial institution. Now, moving to the questions for a for-profit mortgage lender other than a bank, savings association, or credit union, there are now 2 questions. The question whether home purchase loans and home purchase refinances totaled at least $25 million or 10% of volume has been deleted for 2018 and has the question whether your assets exceeded $10 million or you originated at least 100 home purchase loans, again, including refinances of home purchase loans. The first remaining question is either or. Did you either have a home or branch office in an MSA on the preceding December 31st, or did you receive applications for, originate, or purchase at least 5 covered loans related to property located in the same MSA in the preceding calendar year? Now, covered loan is a new term for 2018 and replaces the home purchase, home improvement, or refinance language that there had been. The other remaining question is the same as for banks, savings associations, and credit unions. Beginning in 2018, the question to be asked is either or, did you originate at least 25 non-excluded closed-end mortgage loans in each of the 2 preceding calendar years, or did you originate at least 100 non-excluded open-end lines of credit in each of the 2 preceding calendar years? Again, this threshold of 100 for open-end loans has been increased temporarily to 500 for the years 2018 and 2019. If your answer to both of the questions is yes, again, you are a covered financial institution. Now that you've determined you are obligated to report, the next question is whether or not a particular transaction must be reported. On this slide, we've put the definitions from 2017 and 2018 side by side. Now, on the right half of the slide, for 2018, the term is covered loan. The most notable difference is the requirement that the loan be dwelling secured to be a covered loan. And for 2018, covered loan includes closed-end dwellings secured and open-end dwellings secured. You also must report applications for a covered loans received, covered loans originated, and covered loans that have been purchased. But note here that a request for pre-approval for a home purchase loan that won't be an open-end line of credit, a reverse mortgage, or multifamily is considered an application if you have a pre-approval program. You also must report pre-approval requests for a covered loan if denied, approved but not accepted by the applicant, or if it results in the origination of a home purchase loan. Now, a brief note on the pre-approval request. This applies if you have a pre-approval program again. Now, ad hoc requests do not constitute a pre-approval program. You do not report pre-qualification requests or loans that are specifically excluded by HMDA, which we'll list here in a moment. On this slide, we've asked some questions, or we put some questions to ask to help you determine if a loan is going to be a covered loan. Now, the first here is the loan excluded by its purpose? Both the 2017 and 2018 versions have an ag-exempt. The 2018 commentary language is broader than 2017 as it allows for a use of funds or a use of property test. In the 2018 language, a loan or line of credit is used primarily for ag purposes if its funds will be used primarily for ag purposes, or if the loan or line of credit is secured by a dwelling that is located on real property that is used primarily for ag purposes. If it's an ag purpose loan, it's excluded by its purpose and is not to be considered a covered loan. You don't have to go any further. Now, 2018 provides some clarity on business or commercial purpose loans. If you determine that the loan is otherwise primarily for a business or commercial purpose, you must ask whether it is a home improvement loan, a home purchase loan, or a refinance including a cash-out refi. A no answer to all three, and the loan is excluded by its purpose and is not a covered loan. A yes answer to any of the three, and it could be a covered loan. And you proceed to the next question. Per the August changes, CFPB has clarified that a loan or line of credit to improve commercial space in a multifamily dwelling is not a reportable home improvement loan, but a loan or line of credit to improve commercial space in a dwelling other than a multifamily dwelling is a reportable home improvement loan. Now, moving to the second question on this slide, in order to be a covered loan, the loan must be secured, or in the case of an application, it will be secured by a lien on a dwelling. If the answer to the question is no, then you don't have a covered loan and you don't have to go any further. This can certainly be a complicated question, and the CFPB has provided examples of what is considered dwelling secured which can include single-family, multifamily, and mixed-use properties. Dwelling secured includes principal residences, second and vacation homes, manufactured or other factory-built homes, investment properties, individual condo or co-op units, detached homes, apartment buildings or complexes, condo buildings or complexes, cooperative buildings or complexes, manufactured home communities, even if secured only by the land with sites for manufactured homes, mixed-use property if primary use is residential, properties for long-term housing and related services such as assisted living for seniors or supportive housing for people with disabilities, and properties for long-term housing and medical care if the primary use is residential. Structures are not considered a dwelling include transitory residences, RVs, boats, campers, travel trailers, park model RVs, floating homes, houseboats, mobile homes constructed before June 15, 1976, hotels, hospitals, and properties used to provide medical care such as skilled nursing, rehab, or long-term medical care, mixed-use property if the primary use is not residential, structures originally designed as dwellings but used exclusively for commercial purposes, and then properties for long-term housing and medical care if the primary use is, again, not residential. If the answer to the dwelling secured question is yes, then you go ahead and proceed to that next question. Is the loan an extension of credit? If the loan is a new debt obligation, an assumption or completed is completed pursuant to a New York State consolidation, extension, and modification agreement, then go to the fourth and final question. If not, the loan is not a covered loan and there's no need to go any further. Finally, if you've made it to the fourth question, now you check to see if any other exclusions apply. Did you originate or purchase in a fiduciary capacity? Is the security unimproved land? Those are excluded unless you know that the proceeds will be used within 2 years to construct or purchase a dwelling to be placed on the land. Is it temporary financing designed to be replaced by permanent financing at a later time? Is this a purchase of an interest in a pool of otherwise covered loans, such as mortgage participation certificates, mortgage-backed securities, or real estate mortgage investment conduits? Is this a purchase solely of the right to service an otherwise covered loan? Is this a purchase as part of a merger or acquisition, or as part of the acquisition of all the assets and liabilities of a branch office? Is the loan for a total dollar amount that is less than $500? Is the purchase of a partial interest in an otherwise covered loan? And again, if you answer yes to any of these exclusion questions, then it is not a covered loan. And if you answer no to all the questions, again, it is a covered loan. Now that you know you're covered and the loan's covered, do you report? The CFPB uses the same new threshold test here as used to determine if you are a financial institution that is obligated to report. If you meet the threshold for closed end, which is 25 in each of the 2 preceding calendar years, you report all closed-end mortgage applications received, loans originated, loans purchased, and pre-approval requests if denied. Approved, but not accepted, and that's by applicant or results in an origination. Now, on the right half of the slide, if you meet the threshold for open-end, which is 100, and again 500 for 2018 and 19, in each of those 2 preceding calendar years, then you report all open-end transactions or applications received, loans originated, loans purchased, and pre-approval requests if denied, approved but not accepted by the applicant, or results in an origination. Now we're going to move now to the data collection. There will now be 48 data points to collect, record, and report. 25 new points have been added to the 23 existing ones, and of the existing ones, 14 have been modified. Not included in the data points are QM flags, initial draws, risk-adjusted, pre-discounted interest rate, and identification of the MSA or the MD. Now, a slide here, which I believe is 15, shows all of the data points, current ones, both modified and unmodified, those added as provided by Dodd-Frank, and those added under CFPB's discretionary authority. We're not going to take the time to read through these right now, and again, as was mentioned by Kaylin, you'll receive a copy of this slide deck and can use the slide as a reference. For today's purposes, we're going to focus on the new and the modified data fields. The first new data field is the Universal Loan Identifier, or ULI. It can contain up to 45 characters and is comprised of your financial institution's legal entity identifier. That's the 20-character number that is issued to you. Where do you get one? Well, also has up to 23 additional characters. Now, these must be unique. There can be no personally identifiable information contained in them, and they can be alphanumeric, indicated by the A/# sign, plus a 2-character generated check digit. For purchase loans, use the ULI previously assigned to the loan. If you buy a loan without a ULI because it's pre-2018, then you really need to go ahead and assign one. The ULI must be unique, and like a jersey number that's been retired, you cannot report an application in 2030 using the same ULI that was reported for an origination in 2020. When quarterly reporting starts in 2020, you can use the same ULI for an origination that was previously reported for an application in the same year. Next, for 2018, there is no longer a data field for property type. It's been replaced by construction method, and the property is identified as site build or manufactured home. Use site build whether on frame or off for prefab components assembled on site, and for multifamily unless it's a manufactured home community, in which case you want to then report it as a manufactured home. If you have multiple secured properties, you need to pick one and be consistent throughout the data fields, and where the data field doesn't refer to the property, just report the information applicable to the loan. Now, the next data field is modified for 2018. Owner occupancy will be changed to occupancy type, with codes for principal residence, second residence, and investment property. NA is no longer going to be an option. They only get one principal residence at a time, and if the applicant is buying or building a new dwelling that will become their primary residence within a year or upon completion, it's considered a principal place for this particular field. Use principal residence for purchase loans unless loan docs or application shows it is second or an investment. Report as a second residence if the borrower occupies it for a portion of the year and it's not their principal residence, even if it's going to be rented out. Use investment property if the borrower won't occupy the property, whether they intend to generate income or not. Now, the loan amount here is next. It's virtually going to be the same as in 2017. The only change worth noting is that in 2017, if you've chosen to report HELOCs, you report only that line portion intended for home improvement or purchase. For 2018, open-ended loans are covered loans, and you report the amount that's available. Continuing on, we have action taken, and there are codes for 8 different actions: originated, purchased, application approved but not accepted, application denied, application withdrawn, closed for incomplete list, pre-approval request denied, and pre-approval request approved but not accepted. In 2018, reporting pre-approval requests approved but not accepted is no longer optional. Withdrawn pre-approval requests are not reportable. You also must report the date the action was taken. Next is the property location, which includes the property address, county, and census tract. The main change here for 2018 is that property address replaces reporting the MSA and MD. With respect to reporting ethnicity, race, sex, there are expanded subcategories, places for the applicant to select other than a fill-in a free form field, and you must now begin reporting that you either made the determination on the basis of visual observation or surname, or that you did not make the determination on the basis of visual observation or surname. Only category determinations, not subcategories, can be based on visual observation or surname. Only the applicant may self-identify using a subcategory. There are also codes for not applicable and for no co-applicant, and you apply the rules in effect when the application is received. A present applicant can complete the information for an absentee. Age is new for 2018. Use the applicant's age as of the application date and report the age of the first co-applicant, if any. Reporting the purchasing entity is not new, but it's modified slightly. They basically separated life insurance from credit unions, mortgage companies, and finance companies so that life insurance companies have their own code. Also in 2017, a sale to your subsidiary is reported as a sale to an affiliate. For 2018, this type of your subsidiary trumps, so if you sell to your sub that's a commercial bank, it's reported as a sale to a commercial bank. New for 2018, you'll report the credit score and the model used. Report only the credit score relied on. If you average, you only report the average as one score. If you actually rely on multiple scores for a single applicant, just use one of them and be consistent. Only report multiple scores if you have multiple applicants and you rely on a score for each. Reporting the rate spread is modified in that there are no longer any thresholds and you now report to 3 decimals. Use NA where there is no origination for a reason other than application or pre-approval was approved but not accepted. If that's the action, you must report the spread. Lien status is modified slightly in that there are no longer options to report as NA or unsecured. The only choices are first lien or a subordinate lien. Now, continuing to slide 19, reporting the reason for denial will no longer be optional, and you now report up to 4 reasons. NA is a new option for 2018 for use when the loan is originated and not denied, for purchase loans approved but not accepted, withdrawn before decision, or closed for incompleteness. New for 2018 is reporting of total loan costs or total points and fees. These are 2 separate data fields, but you report only in one. Report in the total loan cost field if a closing disclosure is provided. Report in total points and fees if there's no closing disclosure required. For each, use NA if the loan is an open-end line of credit, reverse, primarily for business or commercial purposes, or an application. And for total loan costs, you also report NA if it's otherwise required, but the application was received by the selling entity prior to the integrated disclosure effective date. For total points and fees, you also report NA if it's a purchased covered loan. Now, there are 3 more new data fields, which are origination charges, discount points, and lender credits. These fields are reported if the loan is subject to the closing disclosure requirement, and they are all reported as disclosed. For each of these fields, report NA if an open-end line of credit, reverse, primarily for business or commercial purposes, or if the application was received by the selling entity prior to integrated disclosure effective date. If the amount is revised during the reporting period, use the revised amount. If there are no discount points or lender credits, leave that field blank and do not use NA. Also, new required fields are the interest rate, the prepayment penalty term, and the debt-to-income ratio. For the interest rate, use the amount from the closing disclosure, or if none, use it from the loan estimate. For an application, report the interest rate only if approved but not accepted, and use the rate at approval. Use NA for denied, withdrawn, and closed for incompleteness. Now, for an unknown ARM rate, use the fully indexed rate and report to 3 decimals. Report any prepayment penalty in months using NA for reversed purchase loans, loans primarily for business and commercial purposes, or where there is no prepayment penalty. And then with regard to DTI, report it if it's relied on for your decision, even if it's not dispositive to that decision. Use NA if withdrawn before a decision, even if you calculated it. Also use NA for closed for incompleteness if you didn't rely on it, if the borrower is not a natural person, if it's multifamily, and for purchase loans. Report up to 2 decimals, but only, again, if relied on. Now, there are 3 more new data fields which appear on this slide, CLTV, loan term, and introductory rate period. For the CLTV, use the amount relied on even if not dispositive. If you rely on 2 decimal places, use 2 decimal places. Use NA for close for incompleteness, withdrawn before decision made, even if you calculated the ratio, if you didn't rely on it as a factor, and for purchased loans. The loan term is reported in months measured from origination. For balloons, use the maturity date, not the amortization. Now for HELOCs, use the account termination date, including both draw and repay periods, and use NA if there's no definite term, as in a reverse mortgage. Report the introductory period in a number of months to when the first rate change may occur, even if the adjustment is not required and the future rate is not known. Preferred rates are rates that may change at some future event, and do not report them unless there's a definite expiration date. Use NA for fixed. For property value, use the value relied on, whether it's the appraisal or the purchase price, up to 2 decimals. Use NA when no value is relied on, closed for incompleteness, or application withdrawn before decision, even if the value was obtained. You must report the total number of units, and if multifamily, the number of income-restricted units. For a single-family home, it will be 1. For a manufactured home community, use the total number of sites that secure the loan and are available for occupancy, even if not occupied or no home is attached. You may include RV pads, manager apartments, or other rentable space if considered under underwriting or investor guidelines. If the loan is on a single manufactured home located in the community, report 1 dwelling unit. For condo and co-op projects, report the total number of individual dwelling units securing the loan, and use NA if not a multifamily dwelling, and use 0 if none. Now next, you must report the NMLS number, the automated underwriting system used, and the result obtained from the AUS. Report the NMLS number of the LO with primary responsibility for the file. When reporting the name of the automated underwriting system used, if you use it to evaluate an app, you must report it, even if it's not used in the underwriting process, even if it's a securitizer system, and regardless of whether your intent here is to hold or sell the loan. You report up to 5. Use NA if you did not use an AUS, if the loan was purchased, or if the applicant was not a natural person. You also must report the result generated. If you generate 2 or more results, there's a particular method of selecting the result to be reported for that system. We don't have the time to get into these details today, so again, please feel free to reach out to Richey May if you have questions in this regard. Next, you must report whether the application was submitted directly to your institution. Remember, you may be reporting actions of your agent, but the agent is not considered the financial institution for this item. A rule of thumb here to remember is that for the direct or indirect submission question, your agent does not equal you, but your employee does. And where you direct an applicant to a third-party agent, like a CUSO that performs LO activities on your behalf but does not assist the applicant with applying for a loan with the other institutions, that is a direct submission. And last on this slide, you must report whether a loan is initially payable to you, and it's not if it closes in a third party's name. On this field, you report NA if you had not made a determination when the application was withdrawn, denied, or closed for incompleteness. Now, as an example, suppose an application is submitted to lender A, and lender A makes the credit decision acting as lender B's agent. The loan's initially payable to A, and B purchases it. Well, B reports the origination and not the purchase, and reports that the application was not submitted directly to B and was not initially payable to B. In another example, if the financial institution reported an origination it approved prior to close that closed in the name of a third party, such as a correspondent lender, and that the financial institution purchased after close, the loan was not initially payable to the financial institution. Finally, we have several new loan characteristics which must be identified. For manufactured homes, you must report whether the loan is secured by both the home and the land, or just the home and not the land. If you're only looking to the home value as security, use home and not land, even if state law considers it real property. You also have to report the interest in the land where the manufactured home is located. Is it a direct or indirect ownership, paid or unpaid leasehold? Indirect ownership occurs when the borrower is a member of a resident-owned community structures as a housing co-op. Now, occupants own the entity that owns the land and report this as indirect ownership even if they still have a lease and pay rent. If the borrower resides in such a community but is not a member, use paid leasehold. If locating a home on land owned by a family member without a written lease and no agreement as to rent, report as unpaid leasehold. Now, you must indicate whether the loan features a balloon payment, if it includes interest-only payments, if it allows for a negative AM or other non-AM features. You must indicate whether the loan is a reverse or HECM mortgage, whether it is an open-end line of credit, and whether the loan is primarily for business or commercial purposes. But remember that if it's a loan primarily for business or commercial purposes, it's a covered loan only if it's a home improvement, home purchase, or a refi, and there are no other exclusions that apply. Now we move on to reporting and data submission. Report for the year or quarterly if you in quarterly reporting when an action is taken, even if the application was received in a prior year. So if you receive an application in, say, 2017 but take action in 2018, you'll need to have collected the 2018 data for that file. Data is to be recorded quarterly on the law within 30 calendar days of the end of the quarter in which final action is taken. If you have multiple lenders involved in an origination, only one will report the origination. The decider reports it. It doesn't matter whose name the loan closes in, and if an agent makes the decision, then the principal reports. All data submissions must occur by March 1 via the HMDA platform. If March 1 falls on a Saturday or Sunday, submit it the following Monday. Submissions to the CFPB is deemed submission to your agency. An authorized representative with knowledge of the date must certify it. A subsidiary of a bank or a savings association submits a separate LAR, and the LAR must be retained for 3 years. Now, let's see here. Okay, so these slides have flow diagrams of the current process and the new process. The essential difference they illustrate is that in the new process, the HMDA filer will run the edits within the HMDA platform, and only clean HMDA files will be accepted. All right, slide 27, HMDA information is intended for public disclosure. FFIEC prepares a disclosure statement based on the data submitted. They used to send it to you. Now they'll notify you it's available. Within 3 business days, make a written notice available upon request at each home office and each physical branch in an MSA MD. Keep it available for 5 years in paper or electronic form. You have the option to also make the actual disclosure statement available and charge a reasonable fee for that. As for the modified loan application register or LAR, instead of you redacting it, the Bureau modifies it. There's an identical written notice that must be made available upon request for 3 years, starting immediately after the data year, so January 1. Finally, there's a general notice that must be posted in all of your lobbies. HMDA commentary suggests text for all 3 notices, and the one text will work for all 3. For large lenders, which means those that reported for the preceding calendar year at least 60,000 covered loans and apps, excluding purchase covered loans, you must report quarterly. If your annual reporting for 2019 meets the threshold, then this quarterly reporting will apply to data collected in 2020. Submissions are due within 60 calendar days from the end of each quarter for quarters 1 through 3, not quarter 4, as it simply gets included within your annual report. Now for this slide, I've provided a short checklist of areas that are essential to keep in mind during your implementation process, and it's by no means exhaustive. HMDA changes impact your LOS and other IT systems, your policies and procedures, your vendor relationships, and you must have measures to ensure data integrity. So if you are dealing with sensitive data, you must maintain security measures. At several stages during your implementation process, you should conduct testing and analysis and modify your system based on those results. In case you haven't heard, in March of this year, the CFPB handed down its largest HMDA penalty to date, and that was $1.75 million that was given against NationStar. They were cited for persistent and substantial errors for the years 2012 through 2014. In the order, the CFPB mentions a history of noncompliance. Error rates for the 3 years were 13%, 33%, and 21%, all of which exceeded resubmission error thresholds. If you submit less than 100,000 entries, your error threshold is 10% of the LAR sample or 5% within individual data fields. If you submit 100,000 or more entries, your error rate is 4% of the LAR sample or between 2% and 4% within the individual data fields. And
thank you very much, James.
That concludes mine.
Yes, wealth of information, obviously a lot to take in there, and we appreciate you covering all that. I'm sure that spurs a lot more questions, and again, we'll compile all that in the interest of time here and submit that amongst the group and get everybody's input on the answers that we can send out to all the attendees. So, James, thank you so much. We really appreciate that, and James' contact info is included as well. In case anybody has any specific desires to reach out directly to James. I believe the second CPE poll question should pop up here soon. Along the lines of what James was covering, I believe. Certainly some concerns and worries and thoughts that run through your head with all of this additional information that has to get submitted. Hang with us again as we collect all the results. All right, thank you for that. I think we've collected what we need to. In the interest of time here, we're going to try to speed this up, but Brian and A&M team, please don't feel like you need to shed any time off what you were planning on covering. It's definitely valuable, so take your time. It's my pleasure to introduce first Brian Driscoll from Alvarez and Marsal, and then Brian will take it away and introduce the rest of the talented team he has on the line with him today. Brian's a senior director with A&M in the financial advisory services. He's out of the Charlotte office there, but A&M is a nationwide advisory firm and have professionals all over the country, I believe. At A&M, he specializes in providing sound analytics with focus-based solutions on complex problems that face the financial services industry. His experience has led him to provide various IT solutions, management and finance support in mortgage, consumer, and commercial banking, analytics-based advisory related to foreclosure, SCRA, and risk management. And prior, I think it's worth note that prior to A&M, Brian was a VP in the Structured Transactions Group, Structured Transactions and Analytical Research Group at Wachovia, providing valuation analysis, reporting on mortgage buying patterns, valuing MBSs, small business securities, and mortgage servicing. So needless to say, I think Brian and his team have the skills and capabilities necessary to be experts on the topic that they plan on discussing today. With that, Brian, please take it away and share with us an introduction, brief introduction to the rest of the team, and then lead right into your topic.
Thank you so much, Galen. I appreciate it. So first of all, on behalf of myself and the rest of the A&M team, I want to thank everyone for taking time today to discuss regression analysis with me. I do have 3 colleagues with me today that are extremely talented. The first on the screen here today is Richard Hendrick. We call him Rich Hendrick. Rich has more than 30 years experience in the financial institutions, both as a senior risk management officer and he was on the dark side at one time as a certified national bank examiner. Currently, he's been with A&M, and he helps us currently with a lot of our compliance issues and a lot of our compliance clients that have needs. He's been a valuable member of that. He's going to provide some more background today when it comes to regression analysis as far as how regulators take a look at that. The second gentleman that will be joining with us today is Matt Frank. Matt has a PhD in mathematics from this university you might have heard of, Yale. He currently is working. He's currently done a lot of work with analysis, aggregation, and quantitative techniques that have helped numerous banks with their compliance functions. But Matt has also done a lot of work in a lot of different areas when it comes to data analysis and cyber work as well. So a real brilliant mind that we've got on our team with us today to talk about this. And last but not least, Kelly Yao has also joined us. Kelly is a manager within our group here at A&M. She has developed new index portfolios and constructed various analytical models for different securities, as well as manage existing portfolios and provided custom solutions to many different clients. Kelly also has a degree in economics and has done a lot of work with regression as well, and helps us as far as a lot of our analytical projects that we have here at A&M. With that being said, with this talented team we have, what can regression analysis tell you? Well, in a nutshell, regression is a statistical approach that is used to forecast change in dependent variable. Well, dependent variables could be, obviously loan approvals, loan denials, and those type aspects. We're on the basis of change in one or more independent variables, being race, sex, income. And why is this important? Well, what we see is most of the time these institutions, they have an awful lot of data, and they have these different patterns that they're looking at. Well, a lot of times if you're trying to look at this information from a manual perspective, it can become extremely cumbersome. And this data allows you to sort of forecast what you've done in the past, how that data is looking, and where you potentially could have problems, and help to explain those problems. With that being said, regression analysis can help identify patterns of loan approvals and denials where the approved decision can't be explained by factors. Those factors being, for instance, race, sex, etc., and they don't necessarily meet the business needs in the normal course of business with how the business is trying to operate from a profitability standpoint. So now, one of the big items that's going to come back, Rich is going to give a little more flavor on this in just a minute, is regulators are likely going to take a similar approach on this. Lately, we've been seeing that regulators take a look at this across the board and try to analyze, especially when it comes to fair lending, are institutions, being fair? Or do we see a flat line across the approval or denials as far as, equality across race, sex, all those different aspects? And in the past also, we've seen where institutions usually thought of this as being a big bank problem and something a big bank had to work with. That's not really the case anymore. Smaller institutions have historically avoided this, but now we're starting to see where the regulators are starting to more fully look at them as well and apply these techniques to their examinations as well. This also can, cause a lot of different harm if these institutions are not ready, don't have answers that are ready, and they get caught by surprise. Our team looks at this from an aspect of being an extremely valuable tool to manage risk. It can also unwind the spaghetti from all the data that you have, and it can obviously make answers that you can possibly take, and get answers before regulators get there, so that you can quickly and easily decipher what information you have, the rationale for what was happening, and have answers proactively and ahead of them. At this time, I'm going to go ahead and turn this over to Rich Hendrick, and he's going to give us a little bit more flavor.
Thank you, Brian. As everyone probably knows, the regulators do use data analysis to tee up fair lending exams, and plaintiffs' attorneys or advocates can also use data analysis in terms of targeting certain institutions. And regression analysis is critical in each of these cases. The CFPB in particular has warned banks to expect an analytic approach, and they flat out issued a warning about this. They do analysis off-site before they even approach an institution about a fair lending exam. So once you know about an exam, the CFPB is already digging deeper with requests for additional data. You don't want to play catch-up, and you don't want to be surprised by what they conclude. The best thing to do is have your own analytics completed and ready. And it won't be much protection unless your analysis is high quality and statistically sound, because you need to put something up that is at least equal to what the regulator or plaintiff's attorney can bring. You also need to give yourself enough lead time to explain any anomalies and correct any actual problems you discover. That's why an annual fair lending review is so important. It's a bit of a yellow, it's more than just a bit, it's a yellow flag if a regulator finds that you've done no analysis until 90 days before they arrive on site. Fortunately, Regulation B allows a safe harbor for analysis that creates new factual data, and regression analysis typically does qualify. What that means is you can detect problems and have a chance to mitigate them before an exam takes place. It's even possible that your regression analysis can be conducted under attorney-client privilege. However, that's a touchy subject in a lot of ways, so you need to be sure to discuss privilege in advance with Richey May or your internal counsel and avoid any initial missteps that could actually void your right to privilege. And on the next slide, we've outlined 3 options for regression analysis, and we've kind of taken the old Sears Roebuck, good, better, best, except the good one here is only just possibly acceptable. Excel spreadsheets are great for so many things, but they tend to fall short when you have a large data file and complex formulas. Maybe more important, if you use Excel, you're on your own when it comes to explaining outliers or moving to a deeper level of analysis. We don't really recommend this approach. Brian, would you like to talk about the next 2 options up here?
Sure. The second option we have, and thank you, Rich, second option we have is the CRA Fair Lending software, which is one we see a lot of institutions try to go to today. The good and the bad. The good is a lot of times the HMDA data is set up to where it can be easily imported by organizations, and they can put the information in. There are some programmed analysis and canned reports that are very easily to generate. But the problem with these are they're very difficult, to explain. A lot of times institutions have problems when they get these canned reports, they show them, and when questions start to come down to exactly how they created it or what these mean, there become problems. This is due to the fact that, one, most of the software packages are black box, that you can't really see what's in them. If you want to include other data sources such as census information or your own loan level information, sometimes that can be problematic. We've seen where there's limited technical support, and it creates a lot of problems that the institutions have a hard time explaining when regulators ask questions, and they don't really truly have the support they need to be able to, 1, understand it, and 2, explain it. The next option, which we have down at the bottom here below, is, of course, what we're going to say is the A&M best. The reason why we say that is because we have very talented people that do this on a daily basis. Our approach is tailored. We use our statistical expertise to select appropriate models. We also use We use various sets of data, being data from the institution itself, census data, other public information we can grab, along with the HMDA data. We also have compliance experience in fair lending. We have numerous former regulators, industry experts that have been doing this for a long time that can take not only the information that comes out, but can easily explain it. We can easily articulate these patterns, and we obviously have a background in knowing what regulators typically want to see. And we'll also be able to show how it's easily being shown and how you can explain items to make it a little bit more clear during exams. And last but not least, we'll have direct assistance in identifying outliers and mitigating errors, because our team can easily sit down, explain these things, and easily be able to adjust reporting and to help you to explain the data that has been presented. At this point, I'm going to turn it over to Matt and Kelly, and they're going to go through an example of this to kind of show a little bit further how this can be done. And Matt, I'm going to turn it to you.
Okay, thank you, Brian. So we have an example here on this question, is there mortgage discrimination? And in the example, we look at 61,000 applications over a 5-year period in one particular county. And then the dependent variable of the analysis is, was the mortgage application approved? And the independent variables, as you see here, are the amount of the loan, the income of the applicant, the year of the application, 3 variables about the applicant, their race, gender, and ethnicity, and 2 variables about the census tract of the home, namely its median income and its demographics, which is to say the percent of the population of that census tract, which is minority. This data allows us to explore both different applicants and different neighborhoods with different racial compositions to see their effects on loan approvals. And then we can ask both of these questions. Do minorities experience mortgage discrimination? And do minority neighborhoods experience mortgage discrimination? So next slide. Here is one result of that sort of analysis, probabilities of approval by race. So in this case, we see that non-Hispanic white applicants have roughly an 86% probability of having their mortgage application approved in this county. And then we look at other races, and we look at the typical non-Hispanic white applicant, and then we see what a similar applicant who is Hispanic but has the same loan size, the same income, the same year of application, the same minority percentage of the neighborhood, the same median income of the neighborhood, all of those other things we keep constant. And we see that the Hispanic applicant would have only an 82% chance of approval, and the non-Hispanic black applicant only a roughly 80% chance of approval. So in this case, we see a statistically significant difference based on the race of the applicant for the mortgage. Kelly, over to you. And next slide.
Thank you, Matt. The next slide gives us an example for the probability of approval in areas with different percent of minority population. This is a kind of tool that regulators use to look for discriminatory practices. The HMDA axis represents the portion of the neighborhood population that is minority, ranging from 0 to 100. The vertical axis represents the probability of a loan application approval corresponding to each neighborhood population makeup on the horizontal axis. The line shows the probability of approval for non-Hispanic white
applicants. I think there's an echo on the line. I just wanted to point that out. I don't know if anyone else is hearing that.
Yeah, Kelly, would you mind, I think maybe you have the computer audio and phone audio on. Would you mind just exiting one of those 2 programs, if possible?
Oh, sure. Sorry. How about now? Is it better? Okay.
That's better. Thank you so much.
Okay. Hey, Kelly, this is Brian. Why don't you
the line shows the probability of approval for non-Hispanic white applicants. The analysis we presented here, we keep all the other factors the same, including applicant income, loan amount, application year, applicant gender, and median value of the income in the census tract to make sure the percentage of minority population is the only factor affecting the probability of approval. As you can see, the negative correlation between the probability of the loan approval and the percentage of the census tract that is minority is fairly strong. We can take the two extreme cases, for instance. The neighborhood with all white population has a probability of approval as high as 87%, whereas the neighborhood with all minority population has a probability of approval of only 79%. In a fair lending environment, this line is supposed to be flat, indicating there is no discrimination. In this analysis, we can also change the rates to other categories like non-Hispanic Black. We will see a similar pattern. Therefore, the gradually decreasing line could indicate that discriminatory practices may be present in the study area. Back to you, Matt.
Okay, next slide. So here's a guide to some of the statistical techniques that we use. We begin with HMDA data and census data. This would be the publicly reported HMDA data. And at a simple analysis would be that we can use a chi-square test to look for redlining. With a more complicated analysis, we could do ANOVA, that's analysis of variance, to see if there are different approval patterns. And then we could do a logistic regression, like the two that we showed you on the previous slides, to detect effects of prohibited versus legitimate factors. And then 2 slides ago, you saw an example of statistically significant difference by the race of the applicant. And 1 slide ago, you saw an example of statistically significant difference by the racial composition of the neighborhood. So if in any of those we see evidence that there is something worth investigating here by way of discrimination, then we might ask a client for their internal data so that we can do further analysis that might either defend them against the charges of discrimination or that might show that there are problems that they would want to address. And then we can use other statistical techniques like linear regression on the interest rates, which can determine whether the interest rates show sign of discrimination or not. And finally, a matched pair analysis, finding 2 extreme cases of similar applicants treated differently to see if there was a basis of decisions. Next slide. So in situations where we do get extra data from a bank, then we can draw stronger conclusions than just from the public data. In this case, you see receipt of data about price disparity. That's to say the interest rates charged for minority applicants or non-minority applicants. And you can see here we've highlighted that in this case, for both Asian applicants and Black or African American applicants, they paid higher interest rates when their mortgages were accepted in a statistically meaningful way. So this is one of the sorts of conclusions that we could draw from further data from you. And alternatively, we might be able to show that with more detailed breakdowns, there are no significant differences by race. Brian, over to you.
Thank you very much. Just once again, thank you again from the A&M team. Any questions, feel free, we can answer those today, or if it needs to be from a email or later on after the session's over, we can do that as well. We're here to support in any way we can, and thank you for your time.
Thank you very much, Brian, Rich, Matt, and Kelly. All we really appreciate that. There are several questions, I think, so we will be following up. With the 5 minutes we have left, we'll kind of move ahead. Launch CPE Poll question 3 here, kind of along the lines of the A&M presentation. That getting launched, right? Again, give us a moment to collect all responses. All right, thank you, everyone. The last 5 minutes here, like I said, we'll move pretty quickly through this. I'd like to introduce Tyler House. Many of you on the line already know Tyler and work with him closely. He's Richey May's version of the Alvarez team, so to speak, working with data analytics and business intelligence here at the firm. He has recently, he was mainly responsible for what Richey May has up on its website now that takes the HMDA data and is able to quickly analyze and create, various filters and graphs and charts to discover trends and make a meaningful analysis of the industry data that's available there. He also works with many of our clients' financial data, performing compensation studies, doing budgeting and market intelligence, and also helps with agency reporting, mainly with Fannie and NMLS. We pretty much, insist that Tyler join all of our webinars from here on out. He's quite the resource, and you'll see why here in a minute. I'll turn it over to Tyler now.
Thanks, Galen. And thanks to the other teams that presented here. Such great information, really so much, and I'm sure everybody's getting a lot of value out of this. So I'm going to kind of switch gears a little bit. I'm not going to talk about the scary stuff about HMDA. I'm going to talk about, some of the business intelligence stuff that's there. The HMDA data set, it's very remarkable as a business intelligence tool. And I think that gets underplayed a little bit because, a lot of it is compliance and risk driven. But, using the data in that tool or in that set really can help, it's helped our clients understand their markets a lot better, what markets they operate in, and then maybe markets that they're thinking about entering. And then, with all the new data requirements, the intelligence that's available is just, that much more beefed up. At Richey May, we're interested in making that data accessible to, all of our clients who maybe don't have the resources to pull the data together and translate it into meaningful information. So that's one of the reasons why we created the dashboard, the market share dashboard on our website. And I'm going to do a brief how-to. I know we're running close to the end of the webinar here, but I'll just do a brief how-to so you can kind of be exposed to that and understand what we're trying to accomplish. But first, I want to talk about a few of the national trends. All of these trends are trends that can be, evaluated or looked at your local markets that you're in, but we're just going to focus our time on the national trends here. And kind of first, the big news, which, at this point it really isn't news anymore, but it's that the 2016 HMDA data is showing us that independents increased their overall market share by 3.5%, which means they have the largest share of the pie at 48% in 2016. And then looking at the last 3 years, the increases that the independents have experienced totals up to about a 12% increase in market share, which is pretty significant. Commercial banks, on the other hand, their share decreased 3% in 2016, bringing it to 43% for the year. And then if you look at them over the last 3 years, they've seen decreases totaling about 11%. And then additionally, in 2016, independents now own the largest share in all mortgage loan products and purposes except for jumbo, and you can see the percentages that the independents own on this slide. Before the 2016 data came out, we were kind of anticipating or expecting that we'd see some numbers in the data that would show consolidation happening in the industry at a significant rate. But once I got into it, we were looking at it and there was really little evidence of consolidation. In part that might be because some of the consolidation that's going on might not show up until 2017. Nonetheless, there was very little, or a lot less than we expected. For example, if you're looking at the top 100 lenders from 2015 and 2016, there was really only one change in the lenders who made up that list in both years. Also, 50% of the total market was owned by 57 lenders in both those years. And, the one thing that we did see was, because of high volumes industry-wide, there was 57 more lenders in 2016 that originated at least $1 billion in volume compared to 2015. And then for some of these trends, I'm actually going to pull up one of our dashboards. We actually have a dashboard that is a heat map, and it'll talk about some of these trends here. Give it a second to load here. So, overall, residential mortgage volume increased by 20% year over year. That's nationwide, and as you can see on this chart, the western United States saw the largest increases in volume and units, with Washington, Utah, Nevada, Arizona, and Colorado making up the top 5. And if we look at population, we're going to see a little bit of a correlation there as well. So those top 5 states or the top 5 increases for those states were also 5 out of the top 8 states for year-over-year population growth. And then 8 of the top 10 were in the western U.S., with the exceptions being Florida and South Carolina, and I guess, maybe Texas, depending on if you consider Texas to be part of the West or not. If you ask me, my personal opinion is it's kind of its own unique region of and in itself. And we'll change this. And then I don't know if you guys saw, or if any of you guys read the Christmas email, that's one that we religiously read here at Richey May, but there was a note this morning about millennials and how Zillow is seeing that millennials are making up the largest demographic of home buyers at 42%. So we also have a chart here for millennials, and we can see, which states have the highest growth rate for millennials and the population. And again, it's the western United States leading the way, Washington, Oregon, and Colorado topping the charts. All right, and then before we get to a time we'll open it up to a few questions, I just want to briefly show the dashboard here. The dashboard that we created, again, it's really from a market share perspective. It's really meant to allow you to drill in on geographic markets as well as products in those markets, and to see who the top 100 lenders are, what the type of product mix or purpose mix or loan size is, as well as the share by institution type. So as a brief example, I'm just going to open up Denver, since Richey May is headquartered in Denver. And we'll see how this works here. Give it some time. Whenever you show something online that's technology-based, it always goes a little bit slower. At least that's what I tell people. But so here we are, we're looking at the Denver Front Range market, and we're getting the top 100 lenders in Denver. We could change up the product mix that we look at. Maybe we just want to look at FHA, or maybe VA, or just jumbo. And then you can also look at things in volume or units. Now these charts at the bottom, these are aggregates of those markets. If you want to see information by lender, you can actually export this data to Excel. We have a quick export feature. You just click on this export data by lender arrow, and it'll take you to a new page where you can look at, where you can export the data to Excel. A real nice file that'll give you basically all the lenders in those markets. And then at the bottom here, there's instructions on how to export that. The last feature I'll show of our dashboard is just what we call like a lender search. It allows you to pull up a real nice lender profile where you can look at how a lender, where their footprint is, what kind of products are they doing. It's just a nice clean chart here. In the top left, you can select the lender you're looking at, and you get the same metrics that we were putting on the first page of the dashboard. This dashboard also allows you to narrow in on certain geographic markets. Maybe we'll look at the Twin Cities in Minnesota, and then you can see Wells Fargo's operations and numbers for that MSA. All right, so that was my bit for today. I'm going to hand it over to Kalen. I think he's got another poll question.
Yep, one last poll question here, I believe. Yeah, one more. Oh yeah, well, I'll just cover these additional resources. This slide deck will be sent out. I'd be remiss if I didn't offer these websites as some of the details that James had mentioned, and some of the additional information that the A&M team and Tyler started to get into can be found at these websites. CFPB has actually done a decent job at providing a lot of useful tools on their website related to HMDA. So I'd encourage everyone on the line to check this stuff out and make use of it, please. Last poll question here. Launch that quickly. All right. Thank you again, everybody. That concludes the presentation. Here's my contact info, but again, this will be distributed. Our sincerest appreciation, again, for James, Brian, Rich, Matt, Kelly, for joining us today and your expert insights. Special thanks for Tyler as well. Please feel free, as you obtain the contact information for anybody that was on the presentation today, to reach out. We're more than willing to help. Real quickly, we will compile questions, get those out. Please respond to the survey that we'll launch and come to you after the session has concluded. Wish all of you the best for the remainder of the year, and we'll see you again soon on our next webinar. Thank you very much.